Fast. So let's talk about Embassy Office Parks. Strong, hotel NOI coming in. The weakest non-operating income growth is what the company has reported in the last 6 quarters. The distribution growth as well, but they've increased their leasing guidance as well. So let's get chatting with the management. We have with us today Aravind Maiya, who's the CEO. Thanks a lot, Aravind, for joining in. Just the first question is with regards to what led to this hike in leasing guidance. Where is this demand coming from, and what would that mean in terms of revenue coming in for you?
Sure. Thanks, Mangalam. Thanks for having me on the show. Just straight getting to the leasing guidance, right? At the beginning of the year, we had given a guidance of 6 million square feet, and we've increased it to 6.5 million square feet now, largely coming from 3 reasons. One, we've done a record 3.1 million square feet lease up for the first half, which included a 0.6 million square feet of a large renewal of space in our Embassy Golf Links, which is almost 20% of the space there, number one. Number two, as we speak now, we have a 2.5 million square feet of pipeline for the remainder of the year. When you put it together, it gives us the confidence to increase the guidance, but majority of the demand is coming from global captives, which is what we said previous quarter as well. That's the real demand driver for commercial real estate in India.
Okay. All right. Could you just, Aravind, give us some perspective in terms of what the occupancies have been like in Q2 as well? For example, there's been IT weakness, which is continued. Is that going to impact any kind of guidance from your end when it comes to vacancies, what you're anticipating and what you're seeing on the ground?
Yeah, sure. I think for our occupancy full portfolio, we reported 83%. As of September. Having said that, we have guided to a 85% occupancy for the year end and a 88% same store. But what I want to highlight over here is 2 things. I'll come to the IT bit. The 2 largest markets for us, which is Bangalore and Mumbai, doing phenomenally well. Mumbai is at 96% occupancy, Bangalore almost 90%. The slowness is IT is definitely impacting us. I think the profit pressures as well as the continued work from home continues to lead to some exits, because of which our net occupancies are at 83%. But I would say this is the bottom. We are seeing growth from here onwards.
All right. Even as you lease more space and even if occupancies improve from here, the question is that, are you able to hike rentals? I mean, there are 3 vectors of this business, right? Increasing supply of space, increasing occupancy in that space. And the third one is you increasing your rental rates itself. Are you able to do that third one?
Yeah, that's a good question, and I have some very interesting anecdote to share here. But just giving a market overview first. Overall, the rates have increased across the top cities. I think Mumbai has increased by around 3%, Bangalore by 5%. But if you look at our portfolio, generally we tend to lease above market. That is because of the total business ecosystem which we've created. One key number, I think it kind of gives the answer to your question. When you look at a Manyata business park, where there's been a lot of churn, in the last 18 months, we've been able to increase our in-place rentals by 25%. So, what we've done is we've increased it we've been able to lease at a much above market rate, and that has led to the growth in the rentals. So top quality assets like ours, we are able to increase the rent.
Okay. I just wanted to ask you a little bit about your hotels as well, because I think you're adding around, you have some capex which is underway as well, and that segment has been strong for you this quarter. If you could just tell us what's working for you within that segment, what is your guidance, what is your capex?
Sure. Just giving some overview, hotels for us is an amenity in our parks. It not only is it's a business by itself, but it gives us a lot of new leasing wins as well. But having said that, on a standalone basis, they are making good money for us. On an average, we were about 53% occupancy, but the ADRs went up by almost 24% quarter over quarter, right? So for a full year, we're looking at an EBITDA of around 165 crores. Plus, we're constructing 2 Hilton hotels in our Embassy Tech Village, which is a 10 million square feet park. When you look at that micro market, it has 40% of the office supply, but only 15% of the rooms available in Bangalore. So I think that's going to be another growth kicker for us in the hospitality vector.
What about the dividend payout? It was 20.5. It is likely to go all the way up to 22 rupees per unit. What will it be this year, at the end of this year? And what's the path to that 22? By when do you get there?
Sure. Yeah, we've given a guidance of a range, Mangalam, between 20.5 to 22. I think we're going to be in that range without giving a number. But what's very important is we've always been speaking about the growth levers in our business. I think all of these growth levers will kick in by the end of the year, be it the occupancy increase, the mark-to-markets, the 7 million square feet, which we are developing at 20% yields. So we are very clear that the DPU will grow from next year onwards. And at the right time, we'll give a guidance on that also for FY25.
Okay, all right. We're going to leave it on that note. Pleasure speaking with you. Thanks very much for joining in and talking to us. So that is Embassy REIT. They have increased their leasing guidance for FY24. We need to take a short break, but it is earnings season. So on the other side, we'll be speaking to Rajiv Modi from Saskin Technologies to discuss their Q2 performance. Stay tuned.